Welcome back to Raising the Flipping Bar. I'm Derek Marlin, your host, CEO and founder of Elevation. So in our last episode, we talked a lot about my background, and I think that was kind of important to help you learn about me moving 5 different states, 15 different times. It was the blending that I have from the finance side of things and the real estate investing. Fast forward to my professional career, which started out in professional sports marketing, working for the Broncos and CBS television, and then jumping into real estate investing with the crash of 2008, 9, and 10. That's when I first started buying rental properties. So it all kind of paints the picture to how are we going to successfully set the stage for property redevelopment, or fix and flip, as most people call it. So in today's episode, this one is titled Getting Your Financial House in Order. And this one is really important to me, kind of again, leaning back on the finance background. But from a business strategy standpoint, it's super, super important to have both your personal and your professional financial house in order. So really, what does that look like? First, you want to first you want to jump into your assets. So whether it is your primary residence, whether it is rental properties that you might own, whether it's commercial properties, any of those properties or those hard assets that you can tap into, you want to have that as kind of your first, line of defense for the assets that you can use to help fund your fix and flips. Then you want to jump into business ownership or assets that you might have that have value that you can leverage. In addition, you want to look at retirement accounts. So you can have self-directed retirement accounts, you can have 401ks, you can have IRAs, you can have taxable brokerage accounts. Those are all great assets that you can use to either become a more qualified borrower or use that as assets to acquire these fix and flip properties. You then really want to dive into your liabilities. So let's think about, what mortgages do you have on your primary home? What mortgages do you have on your rental properties? What do you have from, student loans or an education standpoint, auto loans, credit card loans, medical debt? The way that I always say it is, there's debt and there's leverage. So to me, leverage is a healthy use of essentially somebody else's money so you can shrink your down payment and you can increase your returns done in a responsible investing nature. Debt, in my opinion, is having that consumer debt. So ideally, and I know we all got to start somewhere and everybody's at different points of the financial spectrum, but you want to hopefully not have credit card debt. You want to hopefully not have too much student debt. Ideally not medical debt, because that's going to really inhibit your ability to A, be a good borrower, and B, run these flips in a profitable manner. You want to jump down into having reserves. To me, this is something that actually was a game changer personally, which is, I said, again, I'm starting to invest in 2008, 9, and 10. And so I said, oh my gosh, what happens if I'm totally wrong and everything just completely goes to hell in a handbasket? Well, with reserves, both personally and professionally, that can really help you, 1, feel more confident, and 2, just have your financial ducks in a row. So the way that I like to look at it is, from a personal standpoint, I wanted to have anywhere from 6 to 12 months of your monthly expenses set aside, liquid cash in a savings account. And I know some people are probably going to listen to this and say, holy crap, how do I do that? How do I get started? I've got that debt. Great. Let's try to get that debt paid off first. Let's then start chipping away at putting together your savings. But ideally 6 to 12 months is great. For me, business then comes second, which is, how do I have reserves to help run my business? Not every flip is going to come down the pipeline perfectly. You're not going to be able to roll from one property or from 4 properties into the next. So there's going to be times where cash flow is not great. So in my opinion, 3 to 9 months is a great number to start with and hopefully end with for business reserves to be on hand. Then my biggest kind of advice and guidance is just start now. Like I said, it'd be great to have 12 months of personal reserves and 9 months of business reserves. I didn't have that when I started, but I got to 6 months pretty darn quickly. And we actually now personally stand at 18 months of reserves, which has come in really handy in 2023. It's definitely been a rocky start to this first half or this part of the year. So build those reserves. Those are super, super key, in my opinion. Then we start to talk about financing a deal. So there's really 4 different ways, in my opinion, that you can finance a deal and that you should, again, have your financial house in order. And what I'm going to do is I'm going to lay this out from the least expensive, which essentially means the most profitable, to the most expensive, technically the least profitable on a raw dollar amount. But when you actually talk about it from a percentage basis, it'll almost be the inverse. So by borrowing money, even though you're paying a higher interest rate, your returns can actually be greater. Let's jump back into the first line, which is cash. Obviously, there's no interest with cash on hand. That gives you the best deal. That is you not paying interest every single month, but you have to have those raw dollars to purchase the property. So if it's a $400,000 property, you've got to have $400,000 in the bank, and then you've got to have renovation money ready to go. So definitely the best way to go, but not everybody has 400 grand starting out. So then you go on to level 2, which is lines of credit. On average, and again, we're recording this first season in 2023 for some context for you guys out there as our audience, is you're going to be paying between 5 and 7% for lines of credit. And somebody might ask, okay, well, great. What am I, borrowing against? So you could have an existing business that has cash value that you could borrow against. And again, you're paying 5 to 7% on those rates. You can also have a stock and a bond portfolio, and that's how we invest at Elevation. And so the great thing about that is that you've got your stock and bond portfolio that is typically still making you money on this side of the equation, even though you might be borrowing on this side of the equation. So in essence, if you can hopefully outperform the interest rate that you're being charged by your bank or by your brokerage, you're actually coming out ahead too. So essentially that's almost like cash. Right now, again, people are paying about 5 to 7% on their line of credit against their stock and bond portfolio. And most banks and most brokerages will give you between 50 and 80% of the value of your portfolio. So let's put some numbers to that. If you've got $1 million in value of your stocks and bonds in your portfolio, banks will give you the ability to be a cash buyer for between $500,000 and $800,000. Again, that should get you hopefully in Denver, maybe 1 flip. A lot of other markets, that's going to give you the ability to do 2, maybe 3 flips at once. So that's what we use at Elevation. That's a great way to help grow your business, pay reasonable interest, and not break the bank, but also not have, $1 million in cash just sitting around. Then kind of the next level are home equity lines of credit. Those are when you've got equity in a property, whether it's your primary residence where you live, whether it's rental properties, that is the difference between the mortgage that you've got and the value of your property. Again, most banks will lend up to about 75 to 80% of the value of your property minus your debt. So for most people, especially, I'll give you kind of my personal background. We bought our home that we're in right now in 2009. Obviously hit the jackpot, got super lucky. We knew it was low. We didn't know it'd be the absolute bottom. And our home has increased in value significantly, but we've paid off our loan a lot quicker. So we've grown a lot of equity in our home. So if we were to take out that equity, we have the ability to borrow several $100,000 against our home in that 5 to 7% interest range, which is great because a lot of times we can use that for your renovation costs. You can also do that against rental properties. So let's say you own a condo free and clear, or you've got a mountain property that you've got a couple $100,000 in equity in. That's another great way that you can borrow against that and use that for your 5 to 7% payments that you're going to make. Again, super reasonable. There's kind of 2 other ways that you can fund and you can start your flip as we again try to get your financial house in order. And the next one is borrowing money from private investors. And so a private investor is typically friends and family. They are people that know you, trust you, love you, and see you as a way for them to make some returns and a good return on their investment, get you started. You're paying a little bit more than lines of credit. You're not paying quite what we'll get to here in a minute, which is called hard money borrowing. On average, in the current environment in 2023, people are paying between 8 and 9% for private money. But the great thing is you're not paying points. And so really what that boils down to is our 4th level of investing, which is hard money lending. And so from an interest perspective, you're going to be between about 10% and 14%. Now, I know some people say, oh my gosh, who would pay 14% interest? A lot of people, when they start out, are paying 14% interest. And the reason being is because hard money lenders are typically having people bring between 10 and 15% of the purchase price of a property to the table to fund a flip. So again, let's keep the math really simple. Let's say that we're buying a property for $500,000. Instead of either having 500 grand sitting around in cash, or having a line of credit that's probably worth 700 or 800,000 and gives you the ability to borrow $500,000, you have between $50,000 and $75,000 in the bank. That's your down payment. Yes, you're paying interest and you're paying a large percentage of interest, but on a cash on cash return, which is how much money are you investing and how much do you make, you're actually making more money than if you funded the whole thing in cash. So again, you're paying between 10 and 14% interest. Hard money does get a bit more expensive, and the reason why is for what they call points. Points is a percentage of the loan of what you're borrowing on day one. So again, if you're borrowing $500,000 and you are paying 1 point, you're going to be paying an extra $5,000 in fees at the closing table. If you're paying 2 points, that's obviously $10,000, and that is definitely hurting the profitability of the project. But again, it's really the only way that a lot of people get started. So those are kind of your 4 tiers or your hierarchy of how do you fund a fix and flip. Along with that, ideally, you want to get a personal financial statement created, which helps you really outline all of your assets, all of your liabilities, talks about your net worth, talks about your liquidity, which is essentially kind of, simply defined as how much access to quick cash do you have. So you can pay for the purchase, pay for the rehab, make your monthly payments, have a contingency plan if something doesn't sell, in the first weekend like it used to. So you want to have a personal financial statement ready to go that you can provide to either your bankers or your lenders. You also, in my opinion, you really want to get pre-approved with between 1 and 2 lenders. So ideally, it's great to have kind of a local hard money or private lender option. And then it's also good, in my opinion, to have more of a national option, because a lot of times, if you go with a person you build a local relationship with, which is great, and they maybe only can loan out to 6 different people, and you find this amazing deal and they say, oh, shoot, sorry, I'm tapped out. You want to have that backup. A lot of times the national companies, while they've got tons of money to lend and it gives you the ability to make quick, snap second decisions, the terms might not quite be as good. It's not quite the relationship-based lending that you might want to, work with as you build your team of investment professionals to help support you. So that really outlines kind of where do you get your money from and how do you get your ducks in a row to, make sure that you're the best possible borrower. After that, you want to get into what I call building your professional team. So you want to line up and make sure that you have a CPA or certified public accountant. To me, that is critical because it's not necessarily always what you make. It's not only the profitability, it's what you keep and ideally pay the least amount of taxes on. Nobody is looking to skirt taxes. Everybody's, paying their share for whatever tax bracket that you might be in. But in the simplest terms, if I can pay less by using smart tax strategies because I've got a great CPA to help me structure that, or more importantly, make good decisions before I get into them, that is of paramount importance. One of the other professional partners that we work with, and I really should have pulled the trigger earlier, honestly, looking back, probably one of my biggest pieces of advice is hire a bookkeeper as soon as humanly possible. That person, even if they're charging you $100 an hour for a good bookkeeper, will save you so much time and energy. It'll, one, help you not make mistakes and probably get assessed penalties and pay taxes. So there went your savings right out the window. More importantly is if you look at your time on a per hour basis, your time as an investor is actually far more valuable than $100 an hour. So hire a bookkeeper as soon as humanly possible. Definitely want to get an insurance broker. Obviously, you've got to have every single property insured, whether it's a rental property or whether it's a fix and flip. And so you want to have a broker ready to help you out. Second, you need to have that property covered from the day you buy it all the way from when you sell it. And you can churn through and either have multiple policies on multiple properties, or we actually have this cool policy. It's called a revolving policy. So we pay every quarter, and then I just send in a report to our insurance broker that says either I was flipping 2 houses or 20 houses, and they adjust my premiums each quarter accordingly. So insurance broker is super, super important. Attorney, definitely very, very important. Nobody loves to use attorneys when it comes to real estate because that means there's probably something going on. Or maybe a challenge or an issue, but it is invaluable, and attorneys are typically worth what you pay. If it is, your brother's cousin who just graduated from law school and is, a family law attorney, but you want them to help you out with your real estate deal, you'll probably get what you pay for versus a savvy, seasoned real estate professional that you might, be paying more money on a per hour basis. Again, worth their weight in gold. So have a real estate attorney dialed up in real estate, not just general law. Then you also want to have, again, 2 lenders, actually almost 3, if I think through this properly, 2 hard money lenders or private lenders to help you fund your flip. And then I also really like to have a lender from a mortgage perspective, because when the market shifted, for example, in COVID for 2020, and then for us in the second half of 2022, when the market shifted rapidly, instead of theoretically losing money on a flip, you might actually want to refinance that property and keep it as a rental, whether it's for 1 or 2 years and get that turned around, or maybe you want to add to your portfolio and keep it forever. So kind of having 3 lenders, now that I think about it, is probably a great way to go. Kind of that next tier, next level when you go through the business growth standpoint are those other professional partners. So business consultants. We've got an amazing consultant that you'll actually meet in one of our further episodes down the road here at the end of this first season. And that person can help you with strategy. They can help you really create your business, talk about staffing. Definitely want to talk about maybe a CFO. That's a person who can help you from a high level, really refine what types of investing you want to do, bringing in sister companies, talking about, rental property investment. So CFO can be really big. Working with marketing staff and experts and professionals, whether it's hiring cold calling companies, whether it's hiring digital marketers, whether it's hiring people to produce this podcast, for example, you want to really work with professionals that know what they're doing. So it's all an evolutionary process of where you're at personally, where you're at from a funding perspective, and really where you want your business to go. So again, that's kind of getting your financial house in order from your professional team standpoint. Then it's also, sometimes this is kind of the non-sexy part of real estate investing, but again, from a protection standpoint, this is really, really important, and that's business formation. So in Colorado, starting companies, and we typically use a limited liability company. Let's also maybe put a pin in this. I'm obviously not an attorney. I'm not a CPA, and I'm not a financial professional, or at least now I'm not. So take this advice with a grain of salt and check with your own professional. But in general, you want to create some sort of entity to own your business, and ideally to own those assets within your business. So we personally primarily focus on LLCs or limited liability corporations. You need a tax ID. Every state's different. I know I've got family in New York, for example, and it's definitely expensive. I think it's over $1,000 or $1,500 to start a company. Still worth it in Colorado. You jump on the Secretary of State website, it's $50 and you're done. It's super, super simple. It's super fast. Highly, highly recommend it. You definitely want to also, again, get insurance. We talked about it. You want vacant property insurance, which means if somebody slips and falls on your property while you're working on it, you've got coverage. And general liability, which is if there's disputes or problems or other things going on besides people slipping and falling, you want that protection as well. Then you definitely want to set up your own bank accounts. Here's a big thing that I see tons of investors do, and it becomes a huge problem when you get down the road, not only personally, but especially when you get into partnerships. They commingle, or what essentially means personal money going into your account, business money going into your account. It becomes an accounting nightmare and a disaster. And so you want a separate business checking account, a separate business savings account, which is great to set money aside after each flip, or ideally for taxes coming up towards the end of the year. And you also want to, in my opinion, have business credit cards. And so again, I would really try to avoid having 5, 6, 7, 8 credit cards. I know some of these get rich quick, seminars from 10 years ago talk about opening up credit cards, maxing those out, funding your deals and your rehabs. Especially in Colorado, rehabbing is too expensive, in my opinion, to do that. And so you want to have, maybe 1 or 2 main credit cards that you're using for your business. Again, don't have your personal charges. That is all the places that you eat lunch at and where you grocery shop mixed in with your Home Depot charges or your Floor and Decor charges. So you really want those separate. And in my opinion, it's great to do that because then you can earn points and you can essentially go on vacation for free. So to me, that's a huge benefit of having separate business accounts. And there's a couple of different ways that you can do that. So when you do your business accounts, a couple of different ways to look at it. I think the easiest way is to take your existing credit card company that you work with. Let's say you've had a Bank of America card for 10 years. You can call them up and you can get a secondary card that is run off of your existing credit. So they're not repulling credit. And it's typically your overall credit amount that they'll give you. And you just have a separate card and you use that to do your business charges. Over time, you can then start to graduate to kind of the big leagues and have a completely separate business card or multiple business cards for multiple businesses. And you get a ton more from a points and reward standpoint. So I typically find that the big banks are actually easier to work with. As much as it's great to have relationships with local banks or credit unions, there's just not as many online bells and whistles, which are important in my opinion. There's not as many access to other products or investment products. So the big banks are actually really, really great to have. And depending upon when you're hearing this episode drop, that we're obviously going through a banking crisis as well. So having your assets in a safe, secure bank is tremendously important. And having ones that are FDIC insured are also super, super important. So again, kind of setting up your financial house in the proper order and getting you teed up for success is of paramount importance. We'll also want to talk about, kind of the next level of credit card is you can do a cash back card. We have a card that we use on Amazon, and that's because we do all of our fixtures and finishes, or the nice things that we put in the house, the light fixtures, the faucets, the door knobs, things like that. We order all those on Amazon and you get 5% cash back. So that math adds up really, really quickly and actually saves you a significant amount of money. So again, kind of gives you an ability to kind of stack and tier and structure your financial house from bank accounts, business accounts, and credit cards. Again, I know for some people, this is kind of getting a little bit into the weeds, but I think it's super, super important. And the last thing that we look at is once you've got your assets dialed, your liabilities dialed, your funding dialed, and your way to fund these deals or your credit dialed, it's really just having that investment reality check. And so really actually a great book that I would recommend is a book called Traction. And the author, his name is Gino Wickman. And there's a 2-page document in that called the Vision Traction Organizer. And it's just a great way to give you just a 2-page business summary of how you're going to operate your business. Ironically, when I went to graduate school a long, long time ago, you're writing 30 and 40-page business plans, which, hey, there's a place for those. I actually use this 2-page version far more often, and I can rinse and repeat and launch businesses much quicker or stress test that, hey, this is probably not the right business to be in. So just from a high-level perspective, have that outline so that you've got where you want to spend your time and how you want to grow your business properly documented. Look at the current market conditions. So again, in 2023, when we're recording this right now, we're in a pretty high interest rate environment. The days of borrowing at 2 and 3% are long gone, and I don't think we'll ever see them again. But that also offers other opportunities along with those challenges. So really kind of dive into what's going on in today's market. The other thing you want to look at is, what do we anticipate in the next 1 to 2 years? Obviously, I don't have a crystal ball. Nobody has a crystal ball. But you want to put your best foot forward to make sure that you are properly, how's the best way to say it, really being smart with assessing your risk and where you think the market is going. So, for example, you don't start to invest in Airbnbs when you should have done your research and known that maybe for your city or municipality, they don't allow Airbnbs. So again, just kind of do your homework for where you think the market's going as well. Also, your comfort level for how much rehab do you want to do? How big of a project do you want to take on? Do you want to start off and do condos? Do you want to come right out of the gate and do $2 million properties? Do you want to renovate a 4-plex? Really, what's your comfort level for how big of a project do you want to get into? Also, more about deal success factors that we're going to talk about actually in this next upcoming episode, which is defining how do I determine, is this a good deal or not? So you want to have those metrics dialed in. So tune into the next episode. We're going to get pretty deep into that. And to me, the way that I look at it is from a longevity standpoint, not to say you shouldn't look 10 years in the future, but we like to look at it in a couple different manners. One, we look at it on a year-by-year basis. Then we also start to look at 3 years, and then we look at 5 years. So by looking at that 1 year, 3 year, and 5 year, that gives you enough runway, if you will, to have a good thought out plan and process, maybe not looking 10 years in the past, maybe not looking 10 years in the future, I should say, and then not being so worried about, oh my gosh, what's going on a week by week basis. So again, I know this might seem like a lot of planning, but it's about mitigating your risk and it's about setting your financial house in order. So if we do kind of a quick recap as we wind down on this episode, it's getting your financial house in order is a huge key to success. And really, in my opinion, it's getting your financing dialed in. Because as you move either up or down that sliding scale of borrowing from cash to hard money, that could be a difference of $10,000 per project. And if you're flipping 10 houses a year, obviously simple math, that's $100,000. That's a significant amount of money. So you want to move up and down that food chain as fast as you can to get you to maximum profitability. So again, the way that we look at it is we really want to engage with our audience and engage with our community. So you can follow us on YouTube, on Instagram and Facebook. So elevationinvest.com, at Elevation Invest, or Elevation Investment Properties. And please do reach out to us. We definitely want to build this community and engage. Again, thank you so much for tuning in. I'm your host, Derek Marlin, and we'll catch you on the flip side.